All right, let's talk about how to understand what's really going on inside a business. We're going to pull back the curtain on something called accrual accounting. It's basically the method that tells you the true story of a company's financial health, and it goes way beyond just the cash sitting in a bank account. So let's get into it. So let me just start with a simple question for you. If a business has a ton of cash in its account, does that mean it's profitable? I mean, it seems like it should, right? But the answer, maybe surprisingly, is not always. And understanding why that is, well, that's the key to this whole thing. It really all boils down to two totally different ways of looking at business. Over on the left, you've got the cash basis. Super simple. Money comes in, that's revenue. Money goes out, that's an expense. Easy. But on the right, we have the accrual basis. And here, timing is absolutely everything. Revenue gets recorded when it's earned, and expenses get recorded when they're incurred, and it doesn't matter when the cash actually moves. This gives you a much, much truer picture of what's going on. So to really get a grip on this, you just need to know two golden rules. These two principles are what control the timing of everything, and they make sure that the financial story a company tells is the correct one. Rule number one is the revenue recognition principle. And it's as clear as it gets. You only get to count revenue when you have actually earned it. That means you delivered the product, you performed the service. Just because a customer paid you upfront doesn't mean you've earned that money yet. And this isn't just some vague concept. There's a whole 5-step process to get it right. You figure out the contract, you identify exactly what you promised to do, you determine the price, and then, and this is the most important part, you only recognize that revenue as you check off each promise. It's a really structured way to make sure revenue hits the books at exactly the right moment. And the second golden rule is the matching principle. Think of this one like a perfect pairing. It says that any costs that you had to pay to generate some revenue, well, those costs need to be recorded as expenses in the exact same time period as that revenue. That way, the profit you show for a month or a year is a real, honest reflection of your performance. Okay, so we've got the rules, but how do they actually work in the real world? Let's start with all those situations where the cash moves before the actual business activity happens. This is what we call the world of deferrals. A deferral is exactly what it sounds like. You're deferring, or pushing back, when you recognize an expense. So when a company pays for something in advance, like a year's worth of insurance or rent, it doesn't just become a huge expense on day one. Nope. Instead, it's treated as an asset, something the company now owns that gets used up over time. Let's see how our example company, Smart Touch Learning, handles this. So on December 1st, Smart Touch pays $3,000 for 3 months of rent. Now, if we were using the cash method, that'd be a massive $3,000 expense, crushing their December numbers. But with accrual accounting, that cash payment just creates an asset called prepaid rent. No expense has been recorded at all yet. Okay, now let's jump to the end of December. A month has gone by, so SmartTouch has used up one of those 3 months of rent, so they make an adjusting entry to move $1,000 from that prepaid rent asset over to the rent expense account. And this is a beautiful illustration of the matching principle in action. The expense for operating in December is recorded in December. Perfect. Here's another quick one. Same idea. SmartTouch started the month with $500 worth of office supplies sitting there in an asset account. At the end of the month, they go in the closet and count what's left, and there's only $100 worth. So where'd the other $400 go? Yep, you got it. That $400 in supplies got used up to help run the business during the month. So an adjustment is made. We move $400 from the asset account to the supplies expense account. See the pattern? We're matching the expense to the period it actually helped generate revenue. Now, this same using things up logic applies to the big stuff too. Buildings, equipment, furniture, through a process called depreciation. But because these things last for years and years, we use a special tool to keep track of how much value has been used up. It's called a contra account. What's so cool about this is how it keeps things separate. See, the furniture asset account on the left, that always shows the original price tag, $18,000. The contra account on the right, accumulated depreciation, is like a running total of all the depreciation expense over time. So the book value, the real value on the books, is just the cost minus that accumulated depreciation. It's a really clever way to track it. Deferrals also work for revenue, not just expenses. So what happens if a customer pays you before you do the work? On December 21st, SmartTouch gets a check for $600 for services they haven't performed yet. Now, that's not revenue, not yet. It's actually a liability called unearned revenue, because now SmartTouch owes the client $600 worth of work. By the end of the month, they've managed to do $200 worth of that job. So they make an adjusting entry. They move $200 out of that unearned revenue liability and into the real service revenue account. They have now officially earned that money, which perfectly satisfies that revenue recognition principle we talked about. Okay, so that covers what happens when cash moves first. But what about the complete opposite? What happens when the work gets done or an expense happens before any money changes hands? Well, for that, welcome to the world of accruals. Accruals are pretty much the mirror image of deferrals. With these, we're recording revenue or expenses that have already happened, but the cash just hasn't caught up yet. It's all about recognizing things as they happen, not just when you get paid. The classic example here is employee salaries. Just imagine, employees worked the last 2 weeks of December, and they earned $1,200. But payday isn't until January. Well, that matching principle says you have to record that $1,200 of salary expense in December, because that's when the employees did the work. It also creates a liability, an IOU, called salaries payable. And it works the exact same way for revenue. Let's say SmartTouch did $800 worth of work for a client right at the end of December, but the invoice isn't due until mid-January. Did they earn that money in December? You bet they did. So they record $800 as service revenue, and they also create an asset called accounts receivable, which is basically the client's official promise to pay up. So we've gone through deferrals and accruals, all this adjusting. But why does it matter so much? Well, let's look at the before and after picture, because the impact is actually pretty incredible. What you're looking at here is the unadjusted trial balance. This is the before shot. It's a list of all the accounts based on what happened during the month, but honestly, it's an incomplete story. It's misleading because it's mostly just tracking cash. It doesn't know about the rent that was used, the supplies that vanished, or the salaries that were earned but not paid. And this is the real story. This is the after. This is a look at the company's assets once all those adjustments have been made. Notice how the building and furniture values are now shown net of their depreciation. The accounts are now telling the truth about their real economic value. That right there is the power of accrual accounting. It gives us a clear, accurate, and reliable picture. So at the end of the day, the big takeaway is that the numbers you see on a financial statement, they aren't just about cash. They are a carefully built story about value being created and value being used up over time. It kind of makes you think, doesn't it? The next time you look at a company report, what hidden activities, what deferrals and accruals are shaping the real story behind those numbers?